Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine the financial instrument measured at fair value through other comprehensive income. In my earlier videos, I've told you the debt financial assets can be measured in three ways. Number one, as a fair value through profit or loss, which have been examined in my earlier video. Another method is at amortized cost. These have equally been examined in my earlier video. Then the third one is fair value through other comprehensive income. For a financial asset to be measured at a fair value through other comprehensive income, it has to pass through two tests. Number one, we have business model test. By business model test, the entity must intend to hold the investment to maturity, but they may sell the asset if the possibility of buying another asset with a higher return arises. The entity must intend to hold the investment to maturity. But may sell the asset if the possibility of buying another asset with higher returns arises. The difference between business model test under amortized cost is that under amortized cost, the entity must intend to hold the investment to maturity. The possibility of buying another asset with higher returns is not under amortized cost. That is the difference. It is from here that the difference arises in business model test under the two methods. Number two, the second test is contractual cash flows characteristics. Test. These are the same as of the amortized cost. The contractual term of the asset must give rise solely to the cash flows that are of principal and interest. The cash flows must solely be of principal and interest. Initial recognition. I've told you by initial recognition, we mean how to recognize the financial assets for the first time. So, to recognize financial assets for the first time, it should be recognized at fair value. 2. Transaction cost must be capitalized. That is, transaction cost should be added to the fair value under this method. It should not be expensed. You add the transaction cost to the fair value. Then subsequent recognition. That is, at the reporting date, you want to recognize financial assets. Number one, the asset will be revalued to fair value. The asset should be revalued to fair value at the reporting date. You revalue the assets to fair value. Gain or loss or gains or losses subsequent to its remeasurement to be recognized in other comprehensive income. Gains or losses subsequent to its remeasurement to be recognized in other comprehensive income. By revaluing the assets, it means if the value was 1 million before, you compare it with the current market value. The market value might increase or decrease to, maybe if it increased to 1.2 million, that means you have a fair value gains. You know, the initial value was 1 million, the latter value is 1.2, giving rise to a fair value gains of 200,000. That is that fair value gains. You should recognize it in other comprehensive income. 3. Interest income. Interest income calculated at the effective interest rate should be recognized in the statement of profit or loss. Profit or loss. You recognize the interest income calculated at the effective interest rate in the statement of profit or loss. Finally, the fair value gain. Fair value gains at the reporting date should be recognized as an asset in the statement of financial position. Please take note of this. Example, on 1st January 20X1, Tokyo bought a $100,000 5% bonds for $95,000, incurring acquisition cost of $2,000. Interest is received annually in arrears. The bond will be redeemed at a premium of $5,960 over nominal value on 31st December 2023. The effective rate of interest is 8%. The fair value of the bond was as follows. 31st December 20S1, $110,000. 31st December 20S2, $104,000 required. Explain with calculation how the bond will have been accounted for over all relevant years. If A, Toko planned to hold the bond until the redemption date. B, Toko may sell the bond if the possibility of an investment with a higher return arises. C, Toko plans to trade the bond in the short term, selling it for its fair value on 1st of January 20S2. This question is obtained from K-Plan Financial Reporting. It's also the same question is also in K-Plan Strategy Business Reporting. So now let's have the solution to the question. Solution. The name of the entity is Tokyo. Now let's go to requirement A. Tokyo planned to hold the bond until the redemption date. So the business model. So in the requirement we have, no, I've told you we have business model test and then contractual cash flow characteristics test. So you have to explain with calculation how the bond will have been accounted for over all relevant years. If Toko plan to hold the bond until the redemption date, know the business model under amortized cost. We said the entity must intend to hold the investment or the asset till maturity. So since Toko plan to hold the bond until the redemption date, which is 2083, according to the question, that means this meets the requirement for amortized cost. Contractual cash flow characteristic test under amortized cost is that the cash flows must be solely of principal and interest. If you look at this question, you can identify the principal and interest as the cash flows. So that means it means the condition for amortized cost. We have 5% bonds, amortization table. So we have year, then opening balance. I've told you that the opening balance must be fair value. Interest income, which will be calculated at the effective interest rate. Then interest received, which will be calculated at the coupon rate of 5%. Then we have the closing balance. Three years involved, we have 20x1, since they intend to hold it in maturity. 20x2, 20x3. The maturity date is 20x3. So the maturity date, we're to on 31st December, redeemed at a premium of 5,960 over nominal value on 31st December 2023. That is the maturity date. And you were told the entity must plan to hold the bond until the redemption date. So, which is the condition for amortized cost. On 1st of January 20x1, Toko bought in 100,000. This 100,000, 5% bought. This is the nominal value. For 95,000. This is the fair value. Incurring acquisition cost of 2,000. Under the amortized cost, we said the acquisition cost, we said it must be capitalized. If you capitalize the acquisition cost, 95,000 plus 2,000, that will be 97,000. So the fair value of the bonds, fair value on acquisition, which is $95,000 plus $2,000. That gives us 97,000 US dollar. So you have that as the opening balance. 20S1, $97,000. We said the interest income will be calculated at the effective interest rate. The effective interest rate is 8%. The effective rate of interest is 8%, while the coupon rate is 5%. So interest income will be calculated at 8%, interest received at 5%. 8% of 97,000. We have 7,760. Then interest received. Interest received 5%. And that will be of the nominal value. It's always calculated on the nominal value, which is 100,000. 100,000. That gives us $5,000. So $5,000. And that will remain constant. 97,000 plus 7,760 minus 5,000. We have 99,760. This is the closing balance in 20S1. And that will become the opening balance in 20S2. 99,760. The opening balance, then 8% of that. That gives us 7,981. 7,981. Then this remains 5,000. While the closing balance? 99,760 plus 7,981 minus 5,000. So we have 102,741. That will be the opening balance in 2023. 102,741. Then 8% of that. 8% of that. That gives us 8,219. 8,219. Then, since it will be redeemed in 2023, how much will be the redemption value? Redemption value will comprises one, nominal value. And the nominal value of the bonds is $100,000. Two, it will be redeemed at a premium. How much is the premium on redemption? The bond will be redeemed at a premium of 5,960. 5,960. Then, three, interest for this year, for 2023, will also be received. So we have interest received. I told you the interest received is always calculated on the nominal value, which is 5,000 as usual. What is the total? 100,000 plus 5,960 plus 5,000. That is total 110,960. So, upon redemption, you subtract that amount. So, opening balance plus this minus this. 102,741 plus 8,219 minus 110,960. So, closing balance is 0. Nothing remains. Now, back to the requirement. You have to explain with calculation how the bonds will be accounted for over all relevant years if TOCO plans to hold the bonds until the redemption date. Now, let's explain now. In 20X1 accounting in year 20X1 interest income of 7,760 will be recognized in the statement of profit or loss. Interest income of $7,760 would be recognized in the statement of profit or loss. Then the closing balance of 99,760 will be recognized as a non-current asset in the statement of financial position. 99,000 99,760 would be recognized as non-current assets in the statement of financial position. In the year ended December 31st, 20x2, interest income of 7,981 will be recognized in the statement of profit or loss. Interest income of 7,981 will be recognized in the statement of profit or loss. And the closing balance of 102,741 and 102,741 will be recognized as current asset in the statement of financial position. Why current asset this time around? So this asset will be redeemed in 20x3. That means you are having 1 more year to maturity. So that is, since it is only 1 year to maturity, so it becomes a current asset. But here, you still have up to 2 years upfront. So that is why we have this as non-current asset. In the year ended December 2023 now, in the year ended December 31st, 2023, 8,219 interest income of $8,219 will be recognized in the statement profit or loss. B. TOCO may sell the bond if the possibility of an investment with a higher return arises. The business model test under fair value through other comprehensive income is that the entity must intend to hold the investment in maturity and may sell them and may sell the asset or financial asset if there is possibility for investment with a higher return. So this requirement B met the conditions for business model test under fair value through other comprehensive income. That means you are expected to make use of fair value through other comprehensive income here. So now let's have that. So if you want to measure it as fair value through other comprehensive income. We said the two tests under this is one, business model test. That is, the entity must intend to hold the investment in maturity and may also sell the asset if there is possibility to acquire another asset with higher returns. So The requirement B in this question met that condition. The contractual cash flow characteristics. The cash flows must be solely of the principal and interest, which is also met in this question. So that means in requirement B, you are expected to make use of the fair value through other comprehensive income. Fair value through other comprehensive income. Now, in addition to this table, so we need this now. So here, amortization table. Opening balance, which is always at fair value. Interest income as earlier calculated. Then interest received as calculated earlier. Closing balance. Then you may have fair value gain or loss, and then the fair value at the year end. The first year is 20S1. The opening balance remains 97,000. We have 97,000. The interest income remains 7,760. 7,760. The interest receipt remains 5,000 as calculated earlier. 5,000. The closing balance will be 99,760. 99,760. How much is the fair value at the end of 20X1? December 31st, 20X1. You have the fair value of the board was as follows. 31st December 20X1, 110,000. So 110,000. This 110,000 is greater than this. By how much? 110,000 minus 99,760. You have difference of 10,240. This is fair value gain. So loss in bracket. The fair value you have here, this is second year 20S2. The fair value you have here will be the opening balance. 110,000. Then how much is the interest income for the second year? The interest income as calculated earlier is 7,981. 7,981. The interest received remains 5,000. So 110,000 plus 7,981 minus 5,000. Then you'll be left with 112,981. How much is the fair value at the end of 20S2? The fair value is 104,000. 104,000. This value is greater than the 104,000. So you have fair value deficit. What is the difference? 112,981 minus 104,000. So you have 8,981. It's a deficit. That is why I put it in bracket. Then the 20S3. The fair value you have as the closing balance in 20S2 will become the opening balance in 20S3. 104,000. The interest income remains as before. 8,219. 8,219. 8,219. The interest receipt remain the same. So we have 104,000 plus 8,219 minus 5,000. That will be 107, 219. Then, remember, the bonds will be redeemed in 20S3. So redemption value, which comprises the nominal value remains 100,000. Then plus premium. Premium, how much is the premium? Back to the question. We have the bond will be redeemed at a premium of 5,960. 5,960. You don't need to consider the interest received since you have dealt with that here. So the total is 105,960. This is what you are supposed to have here. 105,960. The fair value at the end of the period is nil because you are not given the fair value in 20S3. That is nil. So that is why I put 0 there. The difference between this and this is greater than this by 1,259. That is the fair value deficit. The difference between 107,219 and 105,960. In the year ended December 31st, 20X1. You have the interest income of 7,760. This will be recognized in the statement of profit or loss. Interest income of $7,760 will be recognized in the statement of profit or loss. While you have fair value gain of 10,240 in the year ended 20S1. This fair value gains will be recognized in other comprehensive income. While the fair value gains of 10,240 will be recognized in other comprehensive income, OCI. Then 110,000 will be recognized as a financial asset in the statement of financial position. $110,000 will be recognized as financial asset in the statement of financial position. That is for 20X1. 20X1. Then, in the year ended December 31st, 20X2. Interest income of 7,091 will be recognized in the statement of profit or loss. Interest income of $7,091 will be recognized in the statement of profit or loss. And we have fair value deficit of 8,981 will be recognized as other comprehensive income. And fair value deficit or fair value loss of 8,981 will be recognized in other comprehensive income. OCI. Why 104,000 will be recognized as financial asset in the statement of financial position. Why $104,000 will be recognized as financial asset in the statement of financial position. Then we have the year ended. In the year ended December 31st, 20x3. You have interest income of 8,219. Interest income of 8,219 will be recognized. Recognized in the statement of profit or loss. Then, before I wrap up this, we have fair value deficit of 1,259 that will be recognized in the statement in under comprehensive income. Profit or loss and the fair value deficit of 1,259 will be recognized in other comprehensive income. That is the solution to the B part of the question. C. TOCO plan to trade the bond in the short term, selling it for fair value on 1st of January 2022. So since they plan to trade it, that means the investment is held for trading purpose. And where the investment is held for trading purpose, it will be measured or recognized as a fair value through profit or loss. So if you want to recognize this investment as fair value through profit or loss, so initial C, the bonds will be recognized as fair value through profit or loss. Fair value through profit or loss. So, initial recognition, the fair value on acquisition, 95,000. That will be initially recognized. Recognize $95,000 as financial assets. The transaction cost, incurring acquisition cost of 2,000. Acquisition cost of $2,000 should be expensed. This information is for the year ended December 31st, 20X1. At the year end, that is subsequent recognition. At the year end, interest income of how much is the interest income? 5%. It is the coupon rate that will be used where investment is to be recognized as fair value through profit or loss, not the effective interest rate. 5% of 100,000, that is 5,000. Interest income of 5,000, that is 100,000 times 5%. Should be recognized in the statement of profit or loss. The investment will now be revalued. Will now be revalued to, at the end of 20S1, you revalue it to 110,000. To 110,000. The fair value gain of how much? 110,000 minus the initial measurement, 95,000. 110,000 minus 95,000. Fair value gain of 15,000 will be recognized in the statement of profit or loss. Or loss, not OCI, because it is measured as fair value through profit or loss. The fair value of $110,000 should be recognized as financial asset. Then year ended December 31st, 20X2. The cash proceeds the cash proceeds of 110,000 recognized, the 110,000 was financial asset before, recognized as financial assets should be recognized. The reason for the recognizing it is because that investment fair value of the Toko plan to trade in bonds in the short term, selling it for its fair value on 1st of January 20S2. 1st of January, which is the beginning. So that means it doesn't affect December 20S2. It is as at January. The fair value you have in 20S1 is what you are going to have at the date of disposal to be recognized. The cash proceeds of 110,000 recognized as financial assets should be recognized, leaving a nil profit on disposal, leaving a nil profit on disposal. This marks the end of the solution to the question. In my next video, I will examine the disposal of financial assets measured at fair value through other comprehensive income. Please make sure you drop the love emoji. Also share the video with others. Thanks for watching ZICA.